Since the beginning of calendar year 2014, Domino's Pizza has been an incredibly consistent and reasonably fast-growing dividend growth stock. The average growth was 21.12%, and you can see as a result of this fabulous record over this last 9 or 10 years, the company has always commanded a premium valuation of about 31, almost 32 times earnings. Recently, the stock has fallen from being massively overvalued to where you can now buy it at about 28 times earnings. I think it's still a little pricey, but it's starting to look very, very interesting. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. I'm going to brag a little bit. Usually I do a subscriber request on Tuesdays, and I'm a little late this week, obviously, because I was on a short vacation and had an opportunity to check one of the major items I've always wanted to do off my bucket list. I got in, had some tickets to the lottery for the practice round on Tuesday of the Masters. You can see I'm donning the Masters cap and the Masters shirt. It was a fabulous experience, so I hope you forgive me for being a little late this week with the video. But anyway, I'm really excited to be here after spending one incredible morning at the Masters. It is far and above more beautiful than you can even imagine by ever watching it on TV. I was absolutely stunned. Anyway, let's get into the videos here. I was requested to look at Domino's Pizza in contrast to Starbucks. So I started out with Domino's Pizza in the beginning here. And as you can see, it's a very consistent growth stock, and it's averaged about 21% growth for about the last decade. If you look at it from a valuation perspective, the market has always put a premium valuation on it. But if you look at it from a price to sales point of view, it's normally trades around 3 times sales, is trading at 3.3 times sales now, or just slightly overvalued. So I think from a standpoint of sales, Domino's is starting to look, reasonably attractive if you're looking for future growth. The company is expected to slow down to about 7% growth over the next year or two, and back to about 13% growth beyond that. If you look at the company relative to its normal multiple, it would look fairly valued even based on earnings today. So Domino's Pizza has been a very exciting growth stock, if you will. From a performance point of view, the company has almost doubled the S&P, and this is a period of time where the S&P has had incredible performance, as you can see. Over 12%, Domino's would have given you 24%. So let's go ahead and compare that to Starbucks, which I was asked to do. And you can see Starbucks has not done as well as Domino's over these last several years. It's about equaled the S&P 500 on dividends and slightly underperformed it on growth. So let's figure out why that happened. Looking at price to sales, you can see that the company has grown sales at about 12% a year. It normally trades at around 3.9, almost 4 times sales. It's currently trading at 3.18 times sales. So from a standpoint of price to sales, Starbucks looks like it's actually a bargain today. If we look at it from an earnings point of view, once again, you see a company that the market likes to put a real high premium valuation, almost a 30 multiple. So for those of you who are aggressive, a 25.29 multiple on Starbucks, multiple of earnings, that is, of adjusted operating earnings, could actually start to look like a bargain. I know Morningstar puts the fair value at about 106. You can see here by FastGraphs, we'd have it at about 104 if it traded at that premium valuation. From a standpoint of other metrics that I think are important to look at, one thing I like, this has a much better dividend, almost 2.35%. So let's look at it from a standpoint of cash flow, and you can see the company does cover their dividend with cash flow. And let's take a look real quickly at free cash flow. Free cash flow has also covered the dividend very strongly, except for COVID. It did get into a negative, free cash flow, a free cash flow payout ratio that was actually above 100% in 2020. But again, that was primarily COVID. Note that this has a September fiscal year as well, so that's something else to take into consideration. If you look at Starbucks from a standpoint of price to sales, you'll see that it's extremely cheap relative to its normal, price to sales. It's trading at a very low valuation, and this would be $110 according to what Morningstar said. Now, one thing I also want to do with Starbucks, and I want to give a little lesson in valuation here, if you will. I want to go back to operating results. As you can see, you've always had to pay a premium if you wanted to invest in Starbucks. But one thing I want to point out, if you're looking at relatively fast-growing companies, and I define that as anything growing at double-digit rates and really preferably at over 15% annual growth. Starbucks has grown at over 17%. So the reality of it is you can't overpay for a really fast growth stock if you're willing to hold it long enough. But if you're not willing to hold it long enough, it can be very problematic. Here is a case in point. You could have paid a 52 PE ratio back on June of 2006. And going into the Great Recession, I like to call it, you'd have seen a 74.8, almost 75% drop in the value of your investment before, it actually began to recover. Now, if you would have held on to the stock, till even today, even when it was technically undervalued based on historical norms here, you'd have averaged about 11% a year. So you can't overpay for a stock like Starbucks as long as you're willing to hold it long enough. But it will try your patience a lot of different times over this period of time because you'll get overvaluation, move into fair valuation, etc. You can clearly see that the stock has been really highly valued recently and is now, with this correction starting to go on, it's really corrected, very, very nicely here. And it's beginning to get in a position where even as a value investor like yours truly might be willing to take a look at it. I was also asked to look at Scotts Miracle-Gro, which is another reasonably fast-growing but slightly more cyclical company than the other two I've shown you. And this one is fertilizer, agricultural chemicals. It's a materials company, the full sector, where the others have been consumer discretionary. But look at this relationship between earnings and price here. And look what happens when it gets a little overpriced. The market corrects. And, of course, that was stimulated by a drop in earnings, as you saw here. Then we had some really strong years of earnings growth, and as often is the case, the market got overly zealous and really priced this for perfection almost. And since that peak here, and I'm just not going to hit it perfectly, but hitting it close enough, we've had about a 46%. We'll say Scotts Miracle growth has been cut in half just over the last year, since April of 2021. But a lot of that can be attributed to overvaluation, and then a bad year, a non-earnings year expected this year, has put the stock in jeopardy. Now, if you look at this company as I did some of the others here that I've shown you today, when you look at it from a standpoint of other metrics that I think are also very important, let's take a look at price to sales. You can see price to sales has normally been about 1 time sales, has been a good 1.25 times sales. It's now trading about 1.4 times sales. But again, you can see how the price to sales has been reasonably consistent. And when it got disconnected on undervaluation, that was a great time to buy the stock. When it got above price to sales, that would have been a poor time, at least for the short term. And then now, we've gotten to the point where it's coming back into a decent price to sales. So it's kind of interesting from that point of view. When you look at it from a standpoint of operating cash flow, because this does pay a $2 dividend, what I like, I don't really care so much about price here when I'm looking at operating cash flow. I want to see that the dividend is being covered by the cash flows, and clearly Scotts Miracle Growth is covering their dividend by operating cash flow. Free cash flow a couple of times has dipped into negative territory. So that's something, again, you should be aware of. Looking forward, the stock is expected to grow only at about 3.18%, but that's because we expect a down year this year, then followed by a 13 or 14% year, and then an 8% year. The long-term growth rate is expected to be about 7%. So this is actually a reasonably attractive dividend growth stock right now that I think is worth taking a look at. But now its credit rating is only BB+. This is not one of your premium quality growth stocks. But you can see when I put price on the graph here that the stock is trading at a relatively reasonable price. But note that we are expecting another couple of quarters of bad earnings. Once again, we have a September calendar year, so we're looking at between now and next September this September, 2022, as to what we might see the price of Scotts Miracle-Gro would be. Now, one other stock that I do want to talk about in the spirit of where I've been and what happened, I want to look at Acushnet, which is Titleist and FootJoy. This is one of the leading golf companies in the world. Its symbol is actually golf. You can see it's had decent growth over the years, but also just like a lot of stocks that got premium valuation during this raging bull market and is now starting to come into fair value. It's yielding about 1.75%, trading at close to what I would call a attractive price to sales. It's trading at 1.4 times sales. It would be considered really good at around 1.3 times sales. Offers a 1.76 dividend yield and has a 70% sales yield, we'll call it, which is not a metric that I really use. From a standpoint of earnings, it has a 6% earnings yield, which means that it's approaching fair value. I don't believe it's quite there yet, but it's getting there. And, it's in the high end of what I call the value premium with a 9%, 8.9 to be precise, expected growth rate over the next couple of years. And I don't have a long-term growth for it. So these are 4 companies that I think are showing you the results of what's going on in this bear market. We're starting to see a lot of stocks correct. Here's some examples. I was requested to look at these companies. You can see that Domino's has dropped significantly here during this correction. Cushnet, which I just covered, has dropped. Starbucks has had a significant drop. It got up here in the 126 range. You can now buy the stock at 83. So that's a pretty big correction. Scotts Miracle-Gro had a really massive correction during this time frame. But there you have it. This is Chuck Carnevale. I'm glad to be back. I'll be starting my normal subscriber request Tuesdays next week. But I did want to brag once more about the opportunity I had to go to the Masters. It was a superb experience. So I hope you forgive me for being late, but I wouldn't have traded it for anything. If you like this video, give me a like, subscribe to the channel, ring the bell. You might want to take a close look at FastGraphs too, because FastGraphs is really beginning to earn its way now. As we're navigating this bear market, you can start to see where valuations have had such an impact on stock prices and where many of these stocks are starting to come into fair value. And these are just 4 examples of many that I'll be showing over the forthcoming weeks. Thanks for watching.